Hello, everybody. Good evening. Welcome. There are still people coming, but we want to be respectful for those who have come in time or even earlier, and start our seminar. First of all, thank you, of course, to the Graduate Institute for hosting this second episode of the series of seminars that we are developing together. The Club of Rome. I'm that person who there, moderator, Carlos Álvarez Pereira, from Vice President of the Club of Rome. And this is the second seminar of the series. We started one month ago. And I think we have today a really interesting topic, socially responsible banking, money as a vehicle for social change. I was tempted to add a question mark to that expression, but I think we will find a lot of interesting insights. This is, for us, part of the activities of the Club of Rome, which since 2018 are organized in a programmatic agenda around 5 impact hubs, one of which is Rethinking Finance. And that Rethinking Finance addresses financing change as well as changing finance. And in that context, the question we have, or the topic we have today, is really essential, and in particular to go from one to the other, or connecting both. Financing change, meaning making the flow of investments move from where they are going today to what we need for the future, meaning renewable energies, circular economy, etc., while changing finance is more about the structural changes, systemic change of a sector which is obviously essential, but probably, as of today, more part of the problem than part of the solution. And to address this topic, we have three, I think we are privileged by having the 3 speakers we have today. Peter Blom, who is was co-founder and has been until 2021 CEO of Triodos Banque, so a bank designed from the very beginning to practice. Sorry. Sound problem. I was saying Trio. No. We can make a work of contemporary music. No, it sounds.
Not too close.
Too close? How does it sound now? No, but still there is this socially responsible banking with a vibrato in the background. Okay. So sorry, I was saying we have Peter Blom, who was co-founder and CEO until 2022 of Triodos Banque. I was saying a bank who tried really hard, and is still trying, I mean, it still exists, and trying really hard to make real this concept of socially responsible banking. And we have another person who is, I would say, more on the practitioner side than on the academic side, right? So we have, sorry, I'm getting confused with this incident. Isabelle Delécraz Regad, well, client advisor at Alternative Bank Switzerland, and I don't know well your model, but you will explain. And then we will have also a look at the topic from the perspective of somebody who is more on the academic side, and concretely from the side of anthropology, Anna-Riikka Kauppinen, who is a professor in anthropology and sociology. The way we want to have this session run is trying to have, rather than a series of monologues and presentations by each of the speakers, what if we were able to engage in a dialogue, in a real conversation around this big topic, which is of course huge. Dialogue between them, so we will have first round of interventions by each of them, and then that will lead, presumably, I'm sure, that will lead to exchange, to a second round of interactions between them. And then we want to keep a significant amount of time for interactions with you all, with the audience. And in order to do that, instead of not framing at all what the speakers would present, I consulted with them what in your view are the most important questions that we should ask around this topic of socially responsible banking. Because the Club of Rome, in the end, I mean, I usually summarize in saying that when we are good, we ask better questions. So it's very much a question-driven approach to eliminate the blind spots, to look at what works, what doesn't work, what is blocking change, what is blocking this idea of socially responsible banking. So in consulting with the speakers about what are the good questions for this topic, we actually got, and thank you for your creativity, actually got a long list of questions, of which I selected 4 that I'm going to read now. And please feel free to not to take all of them. I don't think you will be able to address all of them, at least not in one run of intervention, but select whatever question you think is more meaningful, and then we will build up on that. So the first question is, what are the mechanisms to ensure that socially responsible banking becomes a widespread practice rather than just a discourse, rather than just a nice discourse or a small thing on the side, right? Second, does socially responsible banking imply foregoing part of the financial return to gain non-financial return that benefits society? And if so, are investors and society ready for that? Ready to do whatever it takes for that? Third, money creation is a key process currently in private hands for most of it. Shouldn't we re-democratize money creation? Shouldn't the national banks create money without debt counterparty to finance social justice and environmental transition? And how does socially responsible banking relate to global politics and structures of wealth accumulation and social inequality? As you can see, all of them very easy questions, for which the responses will be equally concrete and down to earth and and feasible in no time. But fortunately, I'm lucky enough to not to have to answer myself the questions or not to elaborate myself on the questions. This is why we have Peter, Isabelle, and Anna-Riikka here with us. So feel free, Peter. I will moderate also the timing. So for now, let's say 8 minutes or so, but so you have a bit of time to give your feeling, and then we will continue with Isabelle and Anna-Riikka. Peter, your call.
Well, the question is always with money, what is the impact? Are we conscious about it? Can we steer through money to a certain economy, to a certain society? And then you come further, are banks having a role there? When I was a student and a social entrepreneur, I went to a traditional bank and asked for a loan. And I couldn't not convince them that the small conference center and the organic shop, what was attached to it, and the coffee shop, what was attached to it, was a future initiative, what would make money, what could repay them. Because they said, this is not what we know. We know only traditional coffee shops, traditional this. So we cannot give you a loan. So I became very quickly aware, I was only 19, that it's not easy to present a plan to a bank and obtain a loan if you come with a new ID. So that's interesting. And it is, even today, is one of the reasons why we cannot make the transition in the economy go. Because many banks work with models, assessment models of loans who looking to the past and don't look to the future. So new things are not in the models. Now that sounds for you maybe as something what is not visible, but a lot of things cannot happen at the moment because they don't fit the data, they don't fit the models, the IDs. So I think finance has a big impact on transition of society. And for the moment, it is more part of the problem than part of the solution. And as long as bankers are not realizing that they're part of the problem, because they love to be part of the solution, that's a much more positive feeling, but they really have to realize they're part of the problem because they select things on old data, on things who were in the past, and cannot introduce the new things in their models, and therefore new things are not easily to be financed. Just to give you a very simple example, if you go to a bank with an organic agricultural business, most of the banks have not a data of organic markets and say, well, the prices you mentioned are not in my models, are not in my data, so I don't believe actually that you can make this return, so I won't finance. That's a very simple, I simplified it a little bit, but it's a very simple sort of example of why things are not moving forward enough. Now then the social banking movement comes in, why we created Triodos Bank in 1980 and many other banks were created. Alternative Bank Switzerland is one of them. And they are now together in the Global Alliance for Banking on Values, is to prove that you could, with a forward-looking, more inclusive approach, that you can also make a viable bank. And interesting enough, when we created this Global Alliance for Banking on Values in 2009, only 9 banks were members. Now it's almost 80 worldwide. That if you compare the profitability, the solvency of these banks with the big banks, let's say the 50 biggest, largest banks in the world, you can see that they are as profitable. But actually what I find much more interesting, 2/3 of their balance sheet goes to the real economy, where with the big banks, only 1/3 of their assets goes to the real economy. So they're much closer to the real economy, they support the real economy, they're much closer to what the transition is. And therefore, I think social banking, value-based banking, ethical banking, there are different names for it, really can show, are a showcase for the financial sector and for regulators, that you really can run a bank based on real economy, sustainable questions. Only you have to change your model, your assessment models in such a way that you include them in your assessment. So that's an important learning. Do we change the whole economy through that? No. Therefore, we really need a system change. Therefore, finance change is one side, and I've done that for decades, financing the changing projects. But you also have to look at change finance. How are we going to change the system so that intrinsically banking and finance is supporting the change in the economy with a much more forward-looking perspective. And I think that's the interesting thing we see in the Global Alliance for Banking of Values. We also see in the hub of the Club of Rome, where we are rethinking finance and come with recommendations how to change that, what is needed to make that possible. Maybe so far for now.
But thank you, Peter. But may I ask, because it's interesting you mentioned that 2/3 of the assets of social banks go to the real economy. Could you elaborate where do go the 2/3 of the assets of the big banks, which is not real economy?
They're circling around in the atmosphere, making money with money. What in the end is not a feasible way of running our society. So now and then people realize suddenly that making with money is not something what creates value, and then you get an implosion, a trust implosion. That happened in 2008. Suddenly people realize, oh, what is this money actually doing? Is there real something behind it? And they discovered there was not so much behind it. Then you get an implosion, a crisis. And normally you can learn from that. You can say, well, okay, now we go back to the real economy. But interesting enough, the financial system has a tendency to build up again and to create more money. There is even much more money now around than there was in 2008. And lots of that is circling around again. And as long as we all believe there is value behind it, nothing happens. But if we realize, again, maybe there's not so much value behind it, you get another implosion. That is the whole cycle of crisis. And that is fine if it was only a small sector in society, but the amounts we have to absorb as society are so huge that it is an issue of concern of all of us as citizens. So I think banks should not be left to the bankers. Banks should be really a social issue for governments, for people. We are all bankers in the end. Our money is there. So therefore, I think it's quite important that we have this much more on the radar as citizens than we had in the past.
Thank you. Very clear. Isabelle.
Well, do you hear me well?
Maybe a little bit closer. Yeah.
Thank you. As Peter was saying, it's very important that our money goes to the real economy. And this is one of the key things that we're doing at Banque Alternative. It goes from financing entrepreneurs that are investing into products and services that make sense according to our values. And we are financing the Swiss economy. But we're also financing the world's issues through quite a few impact funds. And this is impact investing. And pretty sure you're familiar with impact investing. It's addressing social and environmental issues around the world alongside with the financial returns. So this is actually pushing investors to go into impact. It's not only investing into philanthropy. You will get a financial return, not as quick, maybe over the long term, not favoring the short term. So this is quite important, and we're investing into quite a lot of these impact investing funds, and they are very diverse through the thematics, sustainability thematics, and I think we need more funds flowing to those impact funds. And because we have this feeling that currently socially responsible banking maybe not working as much. And this is also because the population growth is there. So we're addressing issues with some of the impact funds, but then the population is growing, so more inequalities are there. So we need more investments as well. And we're also facing a number of increasing disasters around the world due to climate change. So there will be more and more social matters to address as well. So how do we actually move more funds towards impact investing? And that's a good question. Maybe for traditional institutions, that goes from maybe forego a little bit of short-term profit towards longer-term profit, but also to train their employees so that they can recommend investment, sustainable investment that or make sense for the clients, so they're able to explain those products correctly. Also, another way to do that is to push pension funds to allocate more percentage towards this type of vehicles. Last year, Switzerland was allowed to go up to 5%, and I doubt today they have all allocated up to 5%. So there is a good opportunity for increasing that amount and to address more social issues around the world. One of the questions that I had as well is, how do you address non-financial returns, such as the big topic today, which is biodiversity? And this is key for us, for humankind. And so far, it's been addressed by local states or philanthropy. But how could we, from maybe financial institutions, try to invest into biodiversity projects that are actually returning non-financial performance, but doing good? So that's really a question out there. Also, there is a way of addressing biodiversity differently, which is calculating the footprint that every business has on biodiversity. And there are quite a few initiatives and models that are already existing. And I think we could push institutions to do that as well. So maybe I'll speak later.
Good. Thank you. Anna-Riikka?
All right. Thanks so much for these great openings, Peter and Isabelle. Oh, sorry. This probably, is it? Can you hear me?
Yes.
Yeah?
Yes.
So thank you so much for these openings, Peter and Isabelle. So just to perhaps say as a background, my intervention today comes from the perspective of the anthropology of finance, and then some experience of doing long-term fieldwork in Ghana, in West Africa, where most recently I've done fieldwork in commercial banks. So basically, one of the lessons that I've learned, and I'm still learning through this research, and that informs my approach to the very concept of social responsible banking, is the fact that banks in Ghana and in many other countries in sub-Saharan Africa, around the world, they frequently emerged as objects of popular debate, as well as objects of popular demands to be and act differently. So these kind of demands have been there in different parts of the world. So, for instance, many Nigerian economic historians have looked at how the kind of popular protests that emerged around British banks during the colonial era. So British banks were the dominant banks in West Africa at that time, and they were notorious for credit discrimination. So in the sense that they did not give loans for local entrepreneurs. So these popular protests emerged at that time, and one result was that more Nigerian private banks emerged at that moment, and these banks stated that they're going to do things differently. They're going to act differently to these foreign colonial banks. so in the sense that they would not continue this kind of conventional pattern of credit discrimination that was present in colonial times. So I wanted to give this historical starting point just to say that the very idea, as we're talking about social responsible banking here today in Geneva, which is one of global financial hubs, we can think about our efforts as part of a much broader global comparative scene. These type of efforts have been emerged in different parts of the world, and we can think about those distinctive histories and different stakes that have been voiced as people, publics have been trying to think about what kind of financial institutions we want to create in future, and where and what does it mean to create alternative types of banking institutions. Then also the kind of insight thinking about this proposition for today, money as a vehicle for social change. My approach to that question would come from the basic anthropological insight that money as a medium of exchange can be embedded in social relations and can be used to pursue all sorts of intimate, social, spiritual, even national kind of ambitions and objectives for better and for worse. So this is, of course, so because human beings, they've been creative and experimental with money in the sense that they found all sorts of ways of using money for instance, giving money as a gift to God in religious rituals. So in terms of starting from the idea that it can be socially embedded. But then at the same time, as we're thinking about this potential of money, we also are reckoning with the kind of systemic structures and politics of accumulation and global inequality, environmental extraction, various other goals that we already were addressed that underpin the global financial system. Exactly those percentages that we have very much on the table as to the number of financial flows that are in the sense of how that is just creating money with money and then exacerbating also existing inequalities. So when talking about socially responsible banking, I believe we also need to reckon with those potentially difficult questions of how far are we ready to go in order to confront the system. And in this sense, when thinking about the broader change, is this actually a moment when we should start talking about actual legal mechanisms, targets, quotas, that financial institutions might take up in order to generate such a change? And what would that mean? How would that look like in practice? Who would supervise and impose these kind of quotas? And then the difficult question of sanctions. Who would supervise something like that? So are we also here really thinking about creating new mechanisms of democratic oversight and accountability? In other words, how can financial elites themselves be made more accountable to society at large? And what I'd be very interested to discuss with you, Peter and Isabelle, is given your experience in navigating this system, like you are the pioneers of this system from the 1980s, when these institutions came into existence. How do you navigate a field where at the moment many financial institutions are claiming that they are socially responsible, that they are doing good? Like it seems to have become a very much a global narrative, a global discourse, becoming almost like a mainstream discourse, especially following the 2008 global financial crisis, when this question of the moral responsibility of bankers, that was exactly the pivotal moment when it entered the public agenda. So that was the moment when not only academics, not only publics, but financial institutions themselves started to frame their activities in terms of morality and ethics. But then, as we know, Triodos, Banque Suisse, you started this in the 1980s, way before something like socially responsible banking became fashionable. So in that sense, how do you navigate that terrain right now when this discourse has become much more widespread? So then just to say...
But may I, because you just asked a very good question to them, so why not, you know,
Sure.
and then we go back to you with the...
Absolutely, yeah.
So, yeah, with pleasure. The model that was created in the 90s for Banque Alternative was based on very different values. And the principal values are that we don't want profit maximization, of short-term profit maximization. We want transparency, and we want to align with the values that we have set for the bank. So it means towards the values that there's a huge list of business that are excluded. It was said that we don't want nuclear energy, no chemical industry, no pharmaceuticals that are using corruption processes at some point, et cetera, no multinationals. So this, first of all, there's this list of exclusions, and then a list of business that we decided are key to encourage socially and environmentally. So when we explain all this to our clients and that we don't maximize profit, we redistribute inside the business model. We don't overpay employees. We don't pay bonuses when employees are not paid to sell products, like it is everywhere else in traditional finance. So that is, as a first, very different, and clients understand the difference, and they are very often very surprised. And also salary are transparent, so everyone in the company can look at all the salaries. So there's no discussion about that. There's no internal competition, and teams work with one objective, one target. So the model as a whole is very different, and we explain that to the clients. And you can also, as a client, if you buy the shares of the company, which are not listed, you can also forgo your dividends that will finance our innovation funds. So all these details are apart from the top values, and they're very different. And the client are assessing towards the values. Yes, it makes sense. It actually makes sense. So I will come, or they will not come.
Okay, Peter?
Yeah, I think very much in line with what you were saying. I think it's a combination of things. It's not one trick. The first thing is that very much at the foundation of a social bank, you have to look very carefully that you define the purpose properly, the mission of the bank, and make that something what is not only on the wall for the co-workers to be inspired, but is in the Articles of Association, is something you cannot change in the Articles of Association, very structured approach. But that's not enough. It's also about culture, and culture means which people do you attract? Do you attract them because of financial performance, or you say, well, primarily we want them to come because they subscribe to the mission? Then they have to be good. They have to be good bankers as well. But the mission is key. It's much more easy to teach somebody who's connected to the mission to be a good banker than the other way around, is my experience. So that's another thing. And then you have to go to the methodology. In Triodos, we developed a methodology that every loan officer, as we call them, or business banker, the first question he or she has to ask, what is the social added value of this project? Not is it bankable, not is it financial sound. First, that question has to be on the first page of the application. And if that has been answered properly, then we look to the bankability. Now, you would say, is that so essential? Why don't you first look at the bankability, the financial, and then you check if they are correct? I think there's a very deep mental moment to start first to look big and broad, and what does a project do for society, and then you look at the finances. If you do that every day with every project, checking each other on that for many years, then it becomes part of your behavior and culture. So it's a couple of things you have to do. You have to be very serious about, you have to review, and then it becomes an intrinsic part. And then you still have the issue that other banks are also green now or sustainable. They claim that. But what my colleagues tell me from other banks, they say, we can copy everything what you do, but we cannot copy your culture and your people. And I found that a very deep, respectful actually aspect. So, and customers, clients sense that. They feel this is for the real. This is not because they have been teaching their co-workers that this is a good marketing tool. And that in itself, I think, is the strength of this type of banking. I personally feel that it's actually a big plus that the whole society is looking now for green banking and green banks. And I think the real green banks, who have that in their DNA, can really make the difference by showing that that is what they were founded for, and they can grow. Does it solve the whole transition issue of the economy? No, it doesn't. But it is important that there is a group of front runners who have that deep in their DNA and can show how they have come to that point and how they operate day to day. And there is still a big difference with the mainstream banks.
Mm-hmm. So perhaps just to build on this, so if we think about that, we'd actually need, if we make the proposition that there actually is a need for a new kind of social contract between banks, between governments, between civil society, ordinary people, how would this social contract actually look like? And that's perhaps something that, I mean, now anthropologists are very well known for asking questions rather than but
you
here,
too.
but here, yes, we're in the business of both. So in this sense, if we're trying to think of what would inspire this kind of social contract, like a new kind of social contract in finance, in global financial system, I'm just wondering that whether this history and knowledge that your institutions have accumulated now over the course of almost 40 years, how could that history and knowledge be leveraged in order to actually make new types of propositions for this type of new social contract that also includes institutions of global governance? And that's perhaps, again, coming to this question side, but that's just what your interventions made me think about.
Yeah, but here you are mentioning this idea of new social contract, and I see the two scales, the micro and the macro, in the sense that one thing is the experience of banks like Triodos and Alternative Bank in Switzerland, which start from the very beginning with a different concept of contract with their clients, which is great, but then your expression of social contract evokes something else, which is at the level of society as a whole, which is of course related to this topic of how do we go from financing change, because the social banking is designed to finance not only the real economy, but specific investments which seem to be very relevant for the future, for the resilience, for etc. From there to changing the system, because I see a huge leap in the new social contract of specific entities, specific banks, to a new social contract in society, if you see what I mean. So how do you see that? How do you see that?
Well, I think you have to realize there is a bottom-up approach. We are grassroots banks. We are built by people. And I've learned that sort of scaling up or making big what we do is actually not possible in the sense as a franchise model. Because as soon as you make it a franchise model, the unique effort of people, and I mentioned to you how important it is disappearing very easily. So there is a bottom-up approach from this type of banks. There are examples for other banks. There's a lot of learnings from mainstream banks for what we are doing. They really take that in their own model. And in that sense, the impact is much bigger than just the balance sheet of these banks. I give you one example. We introduced in the Netherlands that you got discount on your interest rates if you have your house on a certain C label. So your mortgage was cheaper if you had an A label, what is the best, and you move from a C to an A label, you got a real discount on your interest rates. That was something what I deliberately brought also to the other banks and say that's something what all banks should do, and that's happening now. Now that is a sort of impact you realize indirectly what has an effect in greening the economy and greening the housing stock in a country. So that is a sort of impact you can have as a unique bank locally. The other question is, and that is maybe the social contract part, what is in itself not so inspiring, but the social contract part is more the top-down. That means that in regulation from central banks, and I'm on the board of the Dutch central bank, so I know the other side as well, that as we do that more in the regulation, we can push banks, force banks, specifically big banks, in a more sustainable direction. So I do feel there is a bottom-up approach. A lot of inspiration comes from that, a lot of examples, innovation. They should share it really generously, I think. At least we try to do that always. And there is a top-down movement, what comes more from government, central banks, who regulate increasingly big banks in the direction of a more sustainable balance sheet total. How does that work? For example, we lobbied for many years, also as a global alliance for banking values, that there will be a surcharge, an extra capital requirement if you are in fossil fuels, in oil. So that costs a bank money, simply costs money. So they are enforced to look at their balance sheet again. A more restrictive measure, what is coming into place, is that there is a concentration risk manager requirement. That means that a central bank can agree with the bank, that is say, well, we know the Paris objectives, show me how you reduce your fossil fuels concentration in your portfolio in the next 7 years to this and this percentage. That I think is also needed. That is the social contract more top down. Inspiring bottom up, more contractual regulatory enforcement top down. And I think they will meet more and more and they will learn from each other. That's my approach that's how I see the change happening, if that makes sense to you. Yeah.
Isabelle, you want to?
Yeah, that makes total sense. So there's not much left to say. Yeah, we're also active on the bottom up with, for instance, giving better rates for credits that are used for renovating housing, for instance. So trying to get involved more private people into and discover the bank that way. Also, as a top-down approach, I think regulations, as you mentioned, Peter, are also key, and there are, I think, a lot of things that are happening into the European economy, European Union already with the EU taxonomy as well, that is pushing businesses to report and to classify their investments, their funds, into categories. So as well, it's pushing for more social and environmental meaningful investments as well.
Well, I'm tempted to be provocative on that point because I'm not at all an expert in the financial sector. But I've been seeing a lot happening around new acronyms of 3 or 4 letters, like ESG, TFCD, etc., etc. And in your opinion, because you are more in the topic than I am, for sure, in your opinion, because sorry to say that, I have sometimes a feeling that wow, there is a lot of efforts being put in that, in defining new accounting standards to reflect in a more transparent way all the dimensions of impact of not only for banks, but also for companies in general. So environmental, social issues. And I've often the impression that this is for sure creating a lot of work for consultants, auditors, lawyers, etc. I'm not I'm not questioning the well-intentioned approach, that the approach is well-intentioned. I'm just questioning if it is through standardization, through the run for creating new standards, while we are talking often of activities which are actually new or developing or in a phase of, so maybe we don't know enough yet to have good standards. Is that run for standardization really a strong incentive for concrete organizations, banks in particular, to change? Is that creating a real pressure to change, but also is that creating the appropriate framework for them to have the capacity to change, if you see what I mean?
Yeah, I see what you mean. It goes both ways, I guess. One way, it creates a lot of jobs and a lot of activities for, first of all, the institutions, the consultants, the people who are thinking about those new laws and regulations and taxonomies. And it can be good, but it has to be dynamic. And we don't all have in the world the same definitions of what is sustainable, and that's very important. For example, they were discussing last year whether within the taxonomy we should include, for example, weaponry as a mean of defending democracy. So then you can discuss whether that makes sense or not, depending on yourself or depending on your organization. So that can create also difficulties for the managers who are picking up companies, and also for the people who are buying the investments. Mm-hmm. So it's not as straightforward, and the end result is not 100% clear. To my opinion.
Yeah, I think for me it's very simple. We have to get rid of fossil fuels, and financing fossil fuel projects is a big problem. So we have to come up with the data and the taxonomy for that, not as a sort of marketing tool, that's one way, but really provided to regulators to make systematic regulation to reduce investments in that. I mean, that's a new dimension. We all together have seen, if we don't do that, the cost will be even much more higher through climate change. So this is a cost we have to take. And the trick is to keep it simple and robust, like with all regulation, but it has to happen. Otherwise, we keep investing money in fossil fuels until it's too late. And I think, therefore, the extra cost, what is not so substantial, but the extra cost we have to make it clear what is fossil fuel, what is not, what are the definitions, is part of that. Mm-hmm. So we have to go that way.
Okay.
Can I just
Anna-Riikka? Yeah, of course.
Briefly comment on this? I mean, what I'm hearing from both of your interventions on this is that basically we need more of the state. We need more of also interventions from intergovernmental organizations to, in fact, make this change. And in this sense, I'm also wondering about the EU taxonomy. I mean, the little I've understood about that is that that doesn't include actual sanctions, right? They are not really legal sanctions as to it's about reporting, right? That you report these. I mean, again, somebody who knows much more about the taxonomy, please, I would be very, this would be very important to lay out that exactly that, what is the mechanism? You are reporting, you are being transparent, you are opening it up, and then what? Like, what is the repercussion? What is the aftermath of that reporting? And how far does it go? Like, how far do we need to go? And that's perhaps, again, where that serious conversation has to come in. There might be some uncomfortable questions as well.
Yeah, no, but you're absolutely right. That is meant for investment funds to avoid greenwashing. that they claim green and it's not green. But what you already see, that some of those funds who said they were green and now have to do the effort to make it all transparent, they suddenly say, maybe we don't do it anymore and we go to a lower category. You have different categories. So you also see that it's not always working in the direction we want to. It's not always making green more, but at least it's more transparent and more clear what is green and what is not. But we need it also, and that was my point, we need also as regulators, central banks, for example, we need that sort of taxonomy to base our regulatory framework on. And that is not free. That is something banks really have to comply with. So in that sense, indirectly, it has also that effect. So it's a more complicated issue than just saying, well, if we make everything transparent, green, everything will go that way. That's not the case. But we needed this taxonomy to build our regulatory framework and to make clear what is green and what is not green.
I'm not sure because we actually interrupted your first intervention. I'm not sure if you have something that you wanted to comment on before going to the public.
That's actually absolutely fine. It was, I think it worked fine.
So maybe we can, by the way, if there is an expert in the EU taxonomy, the intervention is welcome. But otherwise, also feel free to. I mean, I have still plenty of questions. So, yep, please. I don't know. Do we have a microphone? No. Just wait a second. Wait a second, because. So if you could say your name and affiliation just to start with, and then.
Sure. So Rhythm Banerjee, I'm at the Institute with just studying professor's course. So the question to Peter was basically on oil lending. So, I mean, we don't have the loan book data, which is publicly available, but let's say you choose to make it more expensive to, lend in bonds or loans to oil companies. Have you seen oil companies more likely to go to traditional banks where they're more ready to give a discount on the same loan? So, green banks actually now become uncompetitive on oil loans specifically. So if you see what I mean.
Mm-hmm. Well, green banks do not give loans for oil and gas, so that's not. It's not. But
we hope they don't, right?
No, they don't. They don't. That is not for them. It's not the issue. But you could say that technically, economically, that loans become more expensive because you need more capital for that loan. Yeah. So you need more capital in your balance sheet, and capital is more expensive than deposits. So therefore, you have to calculate it in the price of a loan to an oil company. The question is, of course, does that make that oil company to reduce its production? That's the big question. And first, I would say no. They go to alternatives, but they pay a higher price. That higher price is in the competition in the world market with renewable energy is an issue in the end, all theoretically, and therefore renewable energy indirectly benefits from that sort of measures. So I think it does help indirectly, but in a big market with other elements also determining what is happening, it's very hard to trace exactly mathematically if I do this with my interest rate or capital requirements, this is the effect for less oil, but indirectly it does help.
Okay, so you're seeing that in the loan book data?
You can't see it in the loan book yet. That's too early to say, well, green banks don't have it, but other banks. I do know that the more effective way for central banks to regulate that is over the concentration risk. So in a balance sheet of a bank, it's very easy to identify different sectors. Oil and gas is one. And you can say as a central bank, I want you to reduce this portfolio from 10% to 2% over the next 5 years. That is actually much more direct. But then still the question is, if that bank is reducing debt, where does the oil company go to refinance itself? And that's in a free open market always a question you cannot solve. I mean, you have a measure over the market, then you have to accept that in a market things find their own way and believe that with the pricing in the end, it has an effect that alternatives are benefiting from it. That's the theory.
A lady? No, just be, yep.
Karen Wilson. I work on sustainable finance impact measurement. I was with OECD for more than 12 years doing work in this area. And I just wanted to come back to this point about regulation and the role of regulation and policy. And it gets back to what Peter was saying about top down and bottom up. You need both. You need the innovation in the market, especially when the market is new, and the private sector usually drives that. But at some point, you also need that top down, and you need some regulatory boundaries on things. But I always say it's a dance, because you can't have either one be too far in front. If the private sector is too far in front, things get a bit out of control, a lot of washing, not a lot of, and if the public sector gets too far out in front, then you have inappropriate regulations, they don't work for the market. So that dialogue between the public and private sector and the stance of who's in front at which time is really important. Anyway, but I do have a question. Actually, I have two questions, if I can. One is for Peter about the impact of the banking issues, should I say. I won't call it a crisis. And what that means for the progress on socially responsible banking. If we look at some of the banks that have, I don't need to name any.
You can.
And the other is for Isabelle. You talked about impact investing. And if you could just elaborate a little bit more about the kinds of asset classes. Are you talking about private investments and startups, or also about public investments and equity debt? It would be great to hear a little more. Thank you.
Okay, so I will start. Thank you, Peter. For impact investments that we try to diversify the thematics through sustainability. So it can be agriculture funds. Obviously, all those funds are targeting the world, so it would be too difficult to finance only Switzerland. So it's mainly active into developing countries. For example, agriculture funds, microfinance funds, infrastructure funds to give, for example, electricity to remote areas in Asia, for instance, that are those rural areas that have no electricity from their own government. So through biomass or through renewable energy panels, for example. We also have funds that focus on Europe with renewable energy. This theme is quite emphasized, has been quite emphasized this past year. So it's quite doing well. We also tackle social issues through financing women and countries, developing countries, to try to help them develop their own business, to be financial independent as well. We're tackling green bonds funds as well that are financing specific projects from communities or states in various countries. Most of these funds are debts. Some are mixed, so it's a mix of debts and private equity, so participation into projects. And some, very few, are private equity only. One thing that I'd like to say, it's nice to think, oh, we will all invest into impact investing, and why not all the funds are going into impact investing? This is because those funds are not very liquid. because those funds are invested into the real economy. So you're lending to people that are using this money to plant seeds and, so that they can leave before they get the results. So there are conditions. Some of the time it's from 3 to 9 months to get your money back. So you will get your money back, but it takes time. And when you have a client in front of you that says, you know what, I'm buying a house, I need 200K or more, you also need to have funds that are liquid. And this is why most traditional banks are advertising, for example, mandates that are sustainable, ESG. Yeah, it's liquid in 3 days, but it's mostly because what they have in their mandates is stocks and bonds, and they're from the stock market. So in 3 days, everything's liquid, it's there. But when you invest into the market, you're financing the transition, you keep a company going. You're not financing a new problematic as opposed to impact investing, or as we do at Banque Alternative, financing a Swiss company that is doing good. So that's one thing where we need to understand and to educate the public about that. And we also need to educate financial advisors also on that, so they can make clear what is the purpose of the vehicle. Hopefully it answers your question.
I think this is a very important point you're mentioning, because just investing in a liquid, normal market, what so-called ESG, has no additionality for sustainability. It's nice to have a liquid, but it doesn't do anything. It makes those banks not more sustainable. And if you are refraining from liquidity more, like you are saying, then you really have an additionality on the sustainability. And the marketing works like that. It has to be green, liquid, highly profitable, everything. And it's very difficult for people to understand that it's a fake story, actually. Nothing happens there. And if you want something to change, there must be a real effort. So your other question was on sort of what happens with the banks in the US mainly. Credit Suisse is a very touchy subject here in Switzerland, of course, but and it's a different thing, I would say, than what's happening in the US. My take away from that is, and what does it mean for the social banks? I think what you see in the US, the big banks are basically guaranteed by the government. So whatever, if people don't want to run a risk, they go to a big bank. You see that happening. The small local community banks who have still a relation with their customers are actually not in danger, because people realize that if they withdraw their money, they kill their own bank. That's how a bank works. You cannot avoid it. But there is a group of these middle-sized banks, so the 100 billion, 250 billion, where Silicon Valley Bank was one of them. They were only about making money short-term with a speculative model. Sort of maturity of interest rates were used because they were under the radar of supervision. They could do that. And that was exactly what we have warned for all the time. Profits are privatized and losses are socialized. Some of the most libertarian investors in Silicon Valley Bank, they said, but now the government has to come in and they have to help us. Fighting for 40 years against the government, but now they need a government. It makes me very angry sometimes, because that's really untrue to your principles. And I think that group of banks, and you see the middle-sized banks in the US, who only go for the short-term money making, they are in danger. And the bad thing is that we pay for them, we bail them out, we increase the deposit guarantee limits, and nobody learns. And that actually should happen. You should feel, I cannot do it. It's better to support a couple of local banks, social banks, with this limit of 250,000 in deposits. Then you go all in one bank and you count on the government bailing you out. So I think there is a real advantage for social relationship banking. I mean, the relationship with your customers is really important.
There is, well, more, the lady just a few rows behind.
Hi, my name is Razieh Olia. I work in an NGO in trade facilitation. To be honest, I didn't know the concept of social responsible banking, so that's why I am here today. I know that some banks are value-based, but more on religious values, such as Islamic finance, I know of. I don't know if you're familiar or not, but I would be interested to know, I mean, they have a different approach on interest rates, on default interest, and others. Other than the religious aspects, do you see any similarities and the main differences with social responsible banks generally?
I can just say that some of them are a member of the Global Alliance for Banking of Values. And I think the interesting concept behind Islamic banking, that it is something you do together and then you share the profits. You're not distance yourself by saying, well, whatever happens to you, I earn the interest rate. And specifically in Malaysia, we have some members of the Global Alliance. And I think it's not so much the religious component we are looking at. We are looking more at the mechanism where you say we share more the risk, what we think is from a social perspective quite a good model. Cooperative banks do to a certain, credit unions do to a certain extent the same, but only for a limited group. But that's why we have sort of embraced this group of banks particularly.
So they intersect at some point.
Yeah, absolutely. That idea, that what attracted me or us was very much that you share the risk of investing in something, and that it's not like the one takes the risk and the other does not. And that's a very interesting model and makes people much more conscious about it if you put money in a bank or in an investment fund, that it's not for free if you want something to happen with that money. And you should be conscious about it and share the pluses and the minuses. So that is, I think, an interesting aspect of Islamic banking.
Perhaps just to comment briefly on this, it's also quite interesting that how after the 2008 financial crisis, Islamic banks actually became framed as indeed an alternative to conventional finance. Yeah. And one of the key questions there, if I remember correctly, was the possibility that how could we transition from debt-based financial instruments into equity-based financial instruments on a more global scale. In the sense that, of course, then there's been a lot of debates in Islamic economics, in Islamic finance, as to, how alternative is like a sukuk contract, for instance, and how is it that there are different ways of workarounds around that, like in the sense of like the prohibition of interest, for instance. So there is a lot of debate around that. But what I find that what is very interesting is this whole debt equity debate at the moment, and how that equity neither is not unproblematic, right? I mean, that also comes with, yes, you do risk sharing, but you also have a stake in the company that you're investing, right? So it's interesting debate, and it's definitely something to observe in future as to where this debt equity conversation goes. Venture capital is also part of that conversation, definitely, as a kind of form of financing. So that's a great question.
Thank you very much.
So, the gentleman there.
Thanks. My name is Tim, and I'm also a student at the Institute. It's actually my second day back in Geneva. I just finished my internship at Triodos Banque. So, and I must say, I
have only good things to say about Triodos,
exactly.
Right?
I also truly recognize what you said about the culture there. Super warm and kind and genuine culture. For anyone who wants to have a organic supermarket, I would recommend going there in person. The new building is actually wonderful. So
let me clarify, this was not prepared.
No commercial stake here. My question is actually a follow-up to Carlos and Anna-Riikka's inquisitive questions about the future of SRI. So as you said initially, both Triodos and Banque Suisse were very new in this environment and had the space to grow as well, and people could find them. Now you do see there's still more competition. Triodos, for the first time in its existence, now has commercials on TV and Dutch TV, and at the same time it has significant budget cuts to actually make sure that the overhead costs are significantly decreased to compete with other greening initiatives of banks. And considering how the field is also changing and banking is more digital, how does a value-based bank promote itself in a new digital age and show its genuine cultural aspects compared to other banks that are not that mission-driven?
Well, as a CEO who left the bank only 2 years ago, I can't comment. I mean, it's not fair, and I did it in a certain way, and things now change, and I'm not saying it's good or bad. It's just what it is. That's how life is. So I'm not commenting on that, but you can.
That's a very good question, Tim. I think so far, yeah, we have higher risk of higher rate of operations because we tended to do everything ourselves inside the bank, and we do not have that many people around, only 150 inside the whole Switzerland. So this is very small compared to any other organization. So we try to tend to have less cost. And in doing that, we have to do partnerships with other providers and to find providers that are using also maybe artificial intelligence to accelerate the level of information and to be more competitive. But so far, we're very much a bank that has people in person. We take time to answer all the questions, and we're not maximizing the time we spend explaining our model to the clients, and we're not reducing the time to answer any of their questions, and they very much appreciate that. So that differentiates us from maybe the app that will tell you you can invest you can have more impact when you invest so and so. But then it's difficult to find someone, I find, when you have a real question. So that's our difference.
Okay, thank you. François, and then Barry's. And then, yeah, so we still have
François Rossier, so I'm an inclusive finance expert. So we talk a lot about the funds and the banks, and I want to talk a bit about the borrowers, because actually when a bank disperses a loan, it expects the borrower to directly repay the loan to the bank. And so the bank, before disbursing the loan, conducts a risk assessment, the famous due diligence, and if the rating is not good enough, there's no loan. And so the strategy today is how do you transform this potential social borrower into a bankable borrower? And the strategy is to provide technical assistance, business development support, trainings, incubators, and all that. But this is very expensive, and the results are relatively uncertain. And so my question is, wouldn't it be an idea to have a kind of third party that would enter the game and that would supplement the cash flow repayment to the bank based on the repayment schedule? And for the bank, if the bank has a guarantee that the cash flow will come in according to the repayment schedule, they would be relatively relaxed. and the return could be based on the impact and the positive results of achieved by the investment of the bank. But it would be and this third party could be financed, for example, by a micro tax on financial transactions, for example.
Pretty technical question, but
I think everything is possible in principle, but it costs money. And if you like it or not, small loans for banks are not profitable. Now you can tackle it from two ways. You can subsidize them. What you say is actually subsidizing, first a tax and then give a subsidy. You could also say differently that every bank needs a certain portion of its portfolio, and that's happened in India, for example, has to be in the social sector or has to be for SMEs. Then you say to a bank, well, let's say 2%, that's already quite a lot for SMEs. And if this 2% is maybe only cost covering or even making a small loss, and every bank in the marketplace has to compensate that with other income, then you have doing the same, but you keep it into the market and you avoid a complicated subsidy system. Because what I've seen from subsidy system for entrepreneurs, there's always problems because there are people misusing it, the politics, the voters, they all don't like it. It's my taxpayers' money, what goes to somebody who is not honest. They have all examples. You end up in quite a difficult situation. If you regulate it more like every bank has to do so much SME in its portfolio, and it's up to that bank to compensate it in a way, then you have a much more market solution, I would say, with it clearly incentive. So I'm not so in favor of all sort of subsidy instruments. That would be my first reaction.
But if you don't have enough, if you don't have enough bankable borrowers with social, then you are stuck also.
Yeah, but I think if a bank, you still have a lot of instruments. Banks have, there are guarantee funds for SMEs. So 2/3 of an SME loan in the Netherlands, at least, can be guaranteed by guarantee funds. It was very interesting during COVID. I was negotiating with the ministry, with other banks and the ministry wanted to cover 100% of the loan. And I said, don't do that, do only 90%. Because as soon as you give up some of the incentives for the bank to look into it, minister was quite surprised because I said, well, I offer you 100%, do you want 90%? So that's the sort of principles you have to look at. And I think there is enough security. It's more the cost of handling it for a bank that's much more a problem than the security. And therefore the handling could be something they have to absorb in a sort of market-regulated solution where you say 2% of your portfolio has to go for businesses below 250,000. And painful is to say that, and I know it from very close, that every loan below the million for an SME is not profitable, with all the cost of knowing your customer, transaction monitoring, all the legal stuff. That has gone up dramatically because of the regulation. So you have to regulate it in another way, that part of the market, what is very important, is still serviced. But it's something you have to be creative about and not, I would hesitate to go through subsidies.
Okay. Paris.
If I may, I'm going to pass first to my colleague.
Well, just a very quick question. Do you, as a socially responsible banking, have a special entry spot to work with public development bank? I work for a public development bank called IFAD, it's the International Fund for Agricultural Development. Do you get a special entry working with people like organizations like IFAD? I think you should. But I mean, it will make my work much easier I worked for impact investors before and then I moved to IFAD, so I'm trying to make the bridge. But do you get a special treatment if you go to a public development bank? Because, we manage public money. What's better than giving it to impact investors? I don't know. Thank you.
And Barry's,
if I may, because I think my question follows immediately. First, I'd like to say thank you to the panel. It's been really stimulating, and the format, I think, is one that we should be emulating. I was struck by the notion that when we, as social activists and would-be impact investors, think that we can move into the impact investing scale by aggregating larger and larger numbers of small-scale activities, that we believe that that model is is viable. But Peter, you had said something about the danger that as we embrace technologies and other forms of financing, that we lose the richness of social activity at the grassroots level. So I'm fascinated by this conversation about public monies which are invested in the international system or in donor-funded activity that could cease to be ODA, or probably, since anything can be ODA these days, could be counted as ODA. But there seems to me to be a need for a design process, because there are a lot of us spinning our wheels, knowing what we know about food, water, waste, energy, climate adaptation, rehabilitation of land at scale, but we still depend on local action, community-based action. And although we're looking at decentralized autonomous organizations and digitalization, it really is beyond the capacity, I think, of any small group of people to work through what the design features are of such a model. From your experience, do you have some 3 or 4 characteristics that would help us to put together a 50 or 100 million or $200 million initiative, which would be at this food, water, waste, energy nexus? Thank you.
What's your goal?
That's a long question. Not sure I'm the best to answer the question.
I'm not sure if it is a question for today, or because I'm noticing that a lot of the questions actually would fit for the other sessions, you know. But you want to?
May I just comment?
Of course.
I think the notion about a design process is really interesting, and that is something that is very kind of dynamic. And what I'm just wondering, that is this exactly the kind of moment of thinking of like what is actually stakeholder engagement in that design process, and how does that exactly take shape? But that, just to say, like it seems like something actionable. Like what is the design? What would it even refer to? So just to...
But it highly depends. It's relatively easy to do if you have big funders who are seen as professional. Then regulation is really limited, and you have to convince them to let you, to ask them to manage their money on behalf of them, and you have to come with the expertise and say this is the way we assess this sort of projects, and this is the return you can expect, that are the risks. All those things are pretty straightforward. The problem is more if you go to the retail market for investors, then you have to be very, very precise in what you promise. You need a prospectus. You need to define all the risks they may occur, including the liquidity risk. That's an important one. People tend to forget about that. Exactly what you were mentioning. If you're in a project, you cannot easily make it liquid. So then it becomes much more complicated, and regulation becomes heavy, and a lot of the costs go to regulatory measures and to management measures. So that's a choice you make. Right? So some of the more complicated investments, what are not so easy to explain through a prospectus to retail investors, I would not do. I would more go for institutional type of foundations or public money. So that's a sort of design principle I would recommend. And we have done everything, and we failed sometimes, and sometimes was successful, but in the end, this was the split we had to make.
Yeah. The question by Paris reminded me of one of the questions that I put forward at the beginning, which I think we have not, not addressed, at least in a direct way. This question on money creation, and if it should be, well, there are actually several different questions. One is about the democratization, which could be interpreted by call also on what is the role of alternative currencies for the future of what we are talking about. So the mention to community-based projects, isn't that a call to community-based currencies and processes of money creation? And what is your what is your opinion about that? And if it is if it will be only a drop in the ocean anyway, or is it relevant? And the other question is the process of democratization from the point of view of not leaving it mostly in private hands, or giving, of course, to the bank the possibility of money creation, and in particular if money should be created specifically for purposes of environmental and social, addressing environmental and social issues. Could we have a round of, because I guess this question is relevant. So, Isabelle?
Yes. Yes, this is a very important question. I think the money creation from the national banks should not mostly go to the public banks or private banks that will use to then do speculations or reinvest into the finance as a whole, and then
to the circling that Peter mentioned initially.
Earlier, so which will have no impact into the real economy. So as opposed to that, probably include more stakeholders to the table, such as include probably government, but also social banks that are serving a purpose, and how to allocate. Of course, we cannot allocate 100% of it, but to allocate a bigger percentage of that to those actors that are investing into the real economy.
Mm-hmm. Any other comments?
Well, the whole theory of the creation of money is not something we can sort of discuss in 5 minutes here. It's quite complicated. I mean, the definition of creation of money is when private banks grant a loan, they create money, and money has been put back in the system if people save money. So it's always a balance between granting loans and savings, and the net of that means the volume of the money is going up or is going down. And the question is, I mean, so far we have a system where we ask private banks to do that. In fact, they grant a loan and that money is spent in the economy, and therefore money creation takes place. And if people save money, it's reduced again. Now the question is, how do you can manage the volume of the creation of money? And central banks do that through capital requirements and to concentration risk requirements that say, well, you need more capital, and that will reduces sort of the capacity of creating money. So that's the indirect way we do now, and the rest is done by the market. And more and more people have seen that that was out of control. So too much money has been created by private banks than expected, and that create an economy what is uncontrollable. The other one is central banks. ECB is a big money creator by bringing money in the economy. We have seen that for many years. So it's a combination of factors who create money, less or more. And I think there are interesting theories about how you relate that more to what an economy should do. One of the theories, and you can look it up, is the modern monetary theory. What relates it much more to employment, to planetary questions, to what is really needed, and that you do creation not as a sort of free thing in the market and let's see what happens, but that you really allocate it much more concretely to what the needs are in society. I can talk for a couple of hours about it. It's a very complicated topic. It's not easy. It's not like if we do it this way, then it's everything under control. That's not the case. But there are some theories who come up with alternatives. Local currencies is another one, but local currencies are important if there is not enough liquidity in a certain community. It's not an alternative for normal currencies, but it helps sometimes to get things going in a local community, particularly in the past, 100 years ago. Then it was really needed. Now it's less so. It's only nice to know that your local currency is spent with a local bookshop or grocery. That makes it, but in itself, it's not solving the problem of liquidity of those companies. So local currency is something totally different, I would say, than the creation of money question. Democratizing capital is sort of related to it. I think many people realize that banks owned by private shareholders is in itself an issue. That has to do with this whole notion of privatizing profits and socializing losses. And increasingly with every crisis where they are saved, the banks, people wonder, why are we having banks as we have them now? Private, speculative to a certain extent, but we allow it. I mean, don't blame the banks, we allow it. And that's one of the big questions I've not an answer to, but I think that's an important question in the control sphere. How do we control our financial institutions in such a way that they service the real economy and not use the real economy to make money? But we should not blame them. We allow them to do that. So it's very simple to say we blame them. It should be more ethical and this and that. No, this is the market economy we want, and particularly in financial sector, this privatizing and socializing profits and losses is really an issue.
Yeah.
So just to quickly comment on this question of alternative currencies, I just met a PhD student who was doing fieldwork in Geneva on the local currency Le Mans, right? Like that is I just learned about it just like a week ago. And what I learned from her was that actually Banque Alternative Suisse is a close partner with the local current, that there's something in terms of how the transaction moves.
They have an account with us. Yeah.
Exactly. Yeah. And that just made me to thinking about the question today, that since there is a global network of banking on values, there's a global network on social banks, there is also a network of alternative currencies, like these different groupings around the world, they communicate, like they come together, they have their own events, sites. And could there actually be a potential in terms of aligning these two networks? And what might that look like? It's just, just when I met this PhD student who told about this connection, it just made me think about the umbrella organizations that these are part of, and how might those networks actually perhaps come together?
I think it's interesting to see how locally you can grow initiatives, and probably every ethical bank can grow locally initiatives if it fits to their values. And this is how you grow your network.
We had also these groups with accounts with Triodos, but the more fundamental question is, what problem do you solve with a local currency? And that is very important to answer that first, because it is an additional cost. It creates expectation of people. They think they always can switch from the local currency into euro. If that's the case, then just use euro. Doesn't really make a difference. If you can't, what you can do, not with euros, but with the local currency. And our experience was, if we were very honest, it didn't add value. So you have to be very clear first about what problem does it solve, and then I think the mechanisms are there to help them and so forth and so on. There, the banks can really be helpful, but that is a more tactical thing and not more principal thing. Mm-hmm. So I'm slightly skeptical sometimes about those.
There was a question here by the gentleman, if we could get the mic and the other one. So let's take the two questions. Could we have the mic? Sorry. Sorry to put pressure on you.
Too many things at the same time.
Yeah, there. Or in reverse order. At the end, now the gentleman just by you. We take the two questions together, and then because we are getting close
Thanks,
to the
Carlos.
end.
Good evening. I'm Amitabh Shorkar. I'm a fellow at the Global Health Center in the Institute. My question is for Peter. Let me come back to the design question. So this the financialization, what is your opinion about that, the global architect of finance right now? where the banks are very much part of that, but it is not a typical decentralization of banking, rather decentralization of finance control. And then this financialization, if the way it has been going on, and it will go in this way, more or less, how it could actually correspond to the ideals or lofty ideals of social change or social values. This is a question I thought to pose it. And second, for Anna-Riikka, you mentioned about social contract. It's very, very illuminating one, and banks as an agent of the or apparatus of the state institution. My point is that could we also think about the eco-social contract? Why I'm just saying that, see, the deforestation is continuously happening, where in the name of social forestry, and then basically actually oil palm plantation is covering instead of the forest canopy, the green belt is covered by the oil palm plantation, mostly in various subtropical and tropical places. And they have immense ecological impacts, and as well as various pandemics as we have been experiencing. So just thought to mention. Thank you. Thank you all.
Thank you. And then the gentleman here.
First of all, thank you very much for this very interesting exchange. Derek de Stockalber from the Canalistic think tank. I want two questions, or maybe comments. First one to Peter Blom, to come back actually to the beginning of the conversation, which was about risk and the loan you wanted to have but didn't have. So I want to rebound actually on one or two comments this evening regarding technology and digitalization. And I want to have your view. If you had access to trusted data, could you implement it into new types of financial and maybe even monetary instruments? Maybe it's your hat of a central banker, and think about CBDCs, including maybe some negative externalities data, be it to social inclusion or environmental, let's say, negative outcome. And then my second question linked to that, because that might drive new types of behavior from asset allocators, but also users of money. And this is actually to Anna-Riikka. Do you think actually those new type of instruments coming from within could shape behavior and then shape its implicit social contract, meaning actually having a more collaborative dynamic among people as opposed to simply a distributive dynamic? Thank you.
Do you want to start?
Sure. To start with, thanks so much for posing the question on the eco-social contract. This actually made me think about the kind of research that is coming out right now that is trying to understand that how is it sometimes that environmental and social goals may actually come to contradict each other in some of these impact investing instruments, for instance. And this is a real issue that I would imagine that practitioners as well are dealing with at the moment. And how is it that in different kind of context as well, where these projects are being implemented, like how do you actually track over time these impacts? And that's just what your question made me think about as to how, in fact, sometimes you might be doing, for instance, a form of impact investing that has a certain kind of social benefit, but then it has an environmental harm. And then that's the kind of difficult question to think through in the case of these instruments. And then what would it mean indeed to have an eco-social contract where one of the stakeholders is the planet? And that's indeed what has to come, obviously, in that would be the right term, I would say, eco-social contract, rather than social contract. Then your question was about the kind of instruments that are emerging from within, like local, in grassroots level, like you mean in terms of like projects, in terms of just to...
Well, it was new types of monetary instruments.
Yeah.
Drive new types of behavior, simply because you include into it not only financial outcomes, but also...
Yeah, I mean, the basic answer to that would be that experience should be leveraged. And in the sense, how can that be actually scaled up and taken as a kind of a guiding post, but also, again, thinking of the design process that was mentioned earlier, how can these initiatives, what is the kind of more collaborative model of socially responsible banking? How far to the grassroots does it go, also in terms of designing the instruments? And this has been a classic question in development studies, for instance. How do you devise development projects that that you have stakeholder involvement, engagement? So in terms of financial instruments, where does the expertise start from, so to speak? I guess that's the question. How wide are we ready to open the black box of expertise to also think about who has the knowledge to design these practices and products?
And Peter?
Maybe to add a little bit to that, also your other question, I think it's quite interesting. There is a difference between value created where there is a price for and value created where there's no price for. Some things are in the market and some things are not in the market. So the idea that things have only a value if you can price them is where we come from. I think what social banks have a problem with, they create a lot of value what is not priced. And therefore, there are limitations in what they can do. They always have to balance that. And that's in many, that's with agriculture the same. There are a lot of things we don't put prices on. And maybe that's good, but the problem in the economy is you are in the economy, if you don't get a price for it, and you have costs on the other side who have to be paid. You cannot say to your co-workers, sorry, we have a lot of value, but we don't get anything in money for it. So we pass on the value, but not the money. That's not possible. So there's a real limitation in if you are a front runner in this field, to a certain extent you have to accept that is limiting your growth. And that's an important concept where economists are struggling with, how to price things, and should we price things who have a value socially, but are not in the business model of a bank or another business. So that's the struggle I just want to mention. The other thing is about what your question was about the global financial system. What I think it's too big to give one answer, but I think there are some core elements in the financial system. I think the easy way people can transfer money is an issue. So you can say that's all a benefit for everybody, but actually for the financial system, it's a disaster, because look at the banks like Silicon Valley Bank, maybe for the wrong reason. You can very easily move all the money away and then there is no bank anymore. So the liquidity of the system is nice from a certain perspective, but is a problem for another perspective. So I do feel that we not only should look at the size of banks, because big banks are too big to fail is a problem in itself. Actually, they are government banks. We have to be real about it. They're secured by the government. They should be organized like government banks. At least the benefits should not only go to the shareholders, but also to the government, because they guarantee the risk in the end. So that is one question, the ownership of banks, the size of the banks, how do we reduce this fast-going money going around the world? There are some fundamental issues where if we keep thinking in the old way, in the market economy, everything should be free, we will not solve them. And politically, it's a very hard thing to say, well, we leave it to the market, and if people lose their money, sorry for them. We can't do that. It's a real issue. Mm-hmm. What I think is more on the positive side, what I liked in one of the newest initiatives, that the special drawing rights on the EMF, I don't know if you're aware of that, there are drawing rights, you can get money from the EMF, you can convert them actually into money. In COVID, there were drawing rights allocated to development countries. And actually there is now an initiative that the wealthy countries donate part of their drawing rights to the underdeveloped countries, specifically for climate investments. And I think that's a quite scalable and interesting initiative, because then you finally give them the means to also work on climate solutions, renewable energy, you name it. And I think that is a very positive initiative on a world scale, and I would call that what they call in the project beyond Bretton Woods. Bretton Woods is how we have organized IMF and World Bank. in 1944. And these are new initiatives where we make these big instruments we have created more focused on the development of climate adaptation, climate prevention, and so forth and so on. So that's, I think, a very positive thing on a global financial system scale. But that's the two things I wanted to say about. I hope that gives you a little bit of a perspective.
Thank you. So we have consumed our time, the least renewable of all resources. And it runs, as you know, especially when you are doing something interesting, as I think we did here, it runs very fast. I want from each of you just a final line. I mean, literally a line, not a 3-minute statement. Maybe I start with Anna-Riikka. You know that by experience that for anthropologists, almost everything is field work. So what is your final line for this session that we had today?
Well, we see from history that people have always sought to hold financial institutions accountable, and they will be doing so in future. So that's what we're placed some of our hope on. And yeah, maybe start from there.
Good, thank you. Isabelle?
Yeah, I'd like to say that outside of pushing banks, regulation, etc., we should also, all of us, take responsibility and push towards taking more responsibility and stop blaming each other like this triangle of inaction where corporations are blaming individuals, individuals are blaming politics, etc., etc. So there are a number of ways of thinking of what makes sense in your life, how do you consume, how does your money has an impact, and is it aligned with your values, and you can also question your pension funds. So that's just giving you some thoughts of what I can do, feel involved, and have sense, make sense. Does it make sense?
Thanks. Peter?
Very short. I think we should realize we are all bankers. So don't blame the bankers. Very much in line. If you really are looking at yourself and you say what are your assets and your liabilities, you realize that we all small banks, and we just add up in a bank, and then we suddenly feel it's not us anymore. Yes, it is. Very much in line with what you were saying. So we are all bankers, and if we realize that, become more conscious about what we do with our money, what our obligations are, then I think we come a lot further. The other thing, what I learned from a professor in the past, was very interesting to say, well, if the average income of a world citizens is around $11,000, it's an interesting number. So the average income. So there are very rich people, very poor people. He said the interesting thing is that if you have 4 times that amount as an income, you have to be conscious that 4 people working for you all the time in the world. And that is a sort of social sort of notion, particularly for people here in the West who have more money, who earn more money. It's not that we earn it. Other people are working for us. And if we realize that and deal more consciously with that relation, then I think we are really improving. For me, that was for years, I had to think about it a lot, but I felt it was a very, very valuable insight. So other people working for you, if you earn more than the average income of a world citizen. So think about it and think what that means for you. Thank you.
Thank you. So we are done today, but the seminar series will continue that we co-organize the Graduate Institute and the Club of Rome. I want to thank you all for being here, your attention, your questions, and especially thank our speakers. I would wish you, all of you, a good evening, but not without giving first an applause to our speakers. Thank you.